Many people I know rely on financial advisors for their investments in financial futures. As a result, these advisors are often more inclined to recommend traditional investments such as stocks, bonds, and real estate, rather than alternative investment options such as gold and silver. It is common for financial planners to advise clients to stay on the course without even knowing much about precious metals assets, such as U.S. silver coins. While this may seem counterintuitive, in some ways it makes sense since you don't want to make a knee-jerk reaction that you might regret later. Furthermore, a set it and forget it strategy without periodic reviews could also be detrimental to your financial future. Although we don't provide financial advice, we wanted to share with you 4 reasons why most financial advisors won't recommend gold and silver coins as an investment and why we believe that they may be doing their clients a disservice. Traditional investment advice, the American dream. All of us strive for that, don't we? As part of that dream is achieving financial wealth or independence. Many of us look to experts to help guide us in this process. Finding the right expert is key. Many financials planning experts still adhere to a more traditional investment advice model, as we have learned over the years. The more aggressive you are, the higher the potential returns, but the greater the risk in a diversified portfolio. We've heard this time and time again. Conversely, a more conservative approach of a 60-40 or 50-50 stock to bond ratio will reduce your overall risk, but will result in lower returns. In today's market, this may not be the best course of action for many people. As a result of the health crisis, the flaws in this traditional financial model were exposed during the Great Recession of 2008 to 2009. When the stock market crashed after the largest point drop in history. In 2022, the stock market continued to remain volatile as history tends to repeat itself. What about cash? Well, with a current inflation rate of 5% at the time of this video, holding cash hasn't been the best strategy either. How about real estate? Unfortunately, no. Currently, we are in the midst of the largest real estate bubble in history, which is unlikely to end well once it bursts. Unfortunately, this is all the options most financial advisors have to offer. Now, some advisors may recommend TIPS or I bonds, which are bonds that are partially hedged against inflation, but they must be held to maturity to realize the returns, usually 5 years or more. If you need the cash earlier, substantial penalties are assessed if you attempt to cash out of these investments before they fully mature. Further, these options rely on government-provided Consumer Price Index figures, CPI, which don't really reflect the real prices increases we're currently experiencing at the grocery store or, say, at the gas pump. While this traditional investment model may work in a bull market because a rising tide lifts all boats, it may need it to be revised as we enter a recession, or some may even say another depression. The crash may cause the worst recession since the Great Depression, as a result of the amount of money created and injected into the system. All in all, that's a very scary thought. Portfolio diversification. The concept of diversification was briefly discussed earlier. However, diversification only works when asset classes are differentiated in such a way that their value shifts differently than the market at large. In a total non-correlated asset, one goes up and the other goes down. Diversifying your portfolio with non-correlated assets can help you protect yourself from loss when the market swings as well. Stocks and bonds have gone down together in 2022, so their correlation coefficients are too similar to provide necessary diversification. As of right now, stocks might be looking pretty, but I'm curious to see how they will perform in the second half of 2023. When one stock or bond goes up or down, other stocks or bonds will move at the same pace and direction. All your investments heading in the same direction at the same pace is unlikely to provide you with the results you want, especially if when the direction is going down. A major benefit of precious metals investing, specifically gold and silver coins, is that they tend to have a negative correlation with more traditional investments, which allows for needed diversification. As a result, portfolio risk can be moderate and long-term returns can be improved. Any investment with a low or negative correlation to traditional investments is similar. When presented with the evidence, most financial advisors will acknowledge that gold and silver provide diversification to traditional investment portfolios. Furthermore, they perform well when the dollar weakens or devalues. In the last two recessions, if you consider 2020 a recession, gold and silver increased in the value as the Federal Reserve expanded its monetary base. Assets under management. Over the years, I have had frank discussions with financial advisors who admitted that their clients would have benefited from owning gold and silver coins. Why don't they suggest that to their clients if that's the case? Well, the reason could be that it will reduce their assets under management, AUM. What is the significance of that? Well, the majority of financial advisors' planners are compensated based on AUM. They will receive a fee of $10,000 to $20,000 if they have $1 million under management and charge a 1 to 2% annual expense. Their fees will be reduced by 25% if they recommend that their clients allocate a quarter of their investments to gold and silver. ETFs and mutual funds are more likely to be recommended by financial advisors because of this reason. The amount of money they manage for their clients will remain the same, and they won't have to reduce their fees. Gold and silver investments. Suppose your investment advisor acknowledges that gold and silver are good asset classes to add to your portfolio. It's a great start, but what specific recommendations do they have? Typically, they recommend their clients to invest in ETFs or mutual funds. When adding gold and silver to a portfolio, ETFs and mutual funds might not be the best investments. Due to the fact that many of these recommendations are based on derivatives, contracts, and are highly leveraged, they may not be the best investment options. There is an additional element of risk associated with leverage investments, and they are typically not backed by any assets. As an example, GLD and SOV are ETFs that track gold and silver prices, but do not hold enough physical metal to support the number of contracts. Therefore, not everyone will have the option of trading in their GLD ETF for a physical piece of gold. In the past, financial outlets reported a leverage of over 100 to 1 in these investments. Their gold and silver reserves may be just one ounce for every 100 ounces of contracts they have issued. Current confidence in the system supports these paper contracts that carry a high level of risk. It is possible that these investments could collapse if there is a panic and physical gold and silver are demanded to settle the contracts, but they aren't available. The fact that gold and silver and mutual funds and ETFs are typically dollar-based investments is another potential risk. This could be counterproductive if you're trying to hedge against a depreciating dollar. Moreover, as mentioned earlier in the video, closing out an ETF or mutual fund position does not usually result in receiving physical gold and silver. It may not be the best choice for you if your goal is to hedge against the dollar with something tangible. For the most part, I only consider investing in physical precious metals as investments, such as gold and silver coins. The only investments that don't have counterparty risk are physical gold and silver. It is possible for another party to default on their end of the deal if they do not fulfill their end of that deal. In the case of physical gold and silver or bullion in your possession, this is no longer an issue. Physical gold and silver might be a bit more expensive due to premiums and storage, but hey, they're much safer and they should help you sleep better at night.